Welcome back to A Stitch in Tax, Saves Cash. I'm Olatunji Abdulrazak, founder and CEO of Taxable.online. Today's session is incredibly important for every taxpayer, employer, business owner, and tax professional in Nigeria. We are breaking down one of the most transformative sections of the Nigeria Tax Act 2025, the section that defines what income is taxable. This is a game changer, so let's dive right in. First, why does this matter? Nigeria has set a very ambitious goal to increase our tax-to-GDP ratio to 18% by 2026. To hit this target, the new Tax Act, or NTA 2025, has to significantly expand the tax base. Section 4 of the Act is the core of this change. It clearly states that all income, profit, and gains derived from or accruing in Nigeria are taxable unless they are expressly exempted. This is the heart of the new Nigerian tax regime. The Act now uses both the source rule and the residence rule. The source rule means income that comes from Nigeria is taxable, even if it's earned by non-residents. The residence rule means that Nigerian residents might be taxed on their global income, though there are some exemptions. This is a major shift, and it truly affects everyone, from individuals to multinational corporations. So, what exactly is now considered taxable income? Let's break it down into categories to make it easier to understand. First, let's look at business and investment income. The law now captures a very wide range of earnings. This includes profits from any trade, business, profession, or vocation. It also includes royalties and rents, interest and any income from lending, as well as dividends, annuities, and premiums. Consultancy fees, directors' fees, and payments to contractors are all on the list. Even discounts and rebates are now considered. Furthermore, gains from the sale of assets and property are taxable. And this is a big one: winnings, prizes, grants, and honoraria are now formally in the tax net. The Act also modernizes things by explicitly including virtual and digital assets. We're talking about cryptocurrencies, NFTs, and tokens. Gains from the disposal of securities and other money instruments are also covered. Finally, there's what's called a residual clause. This is a catch-all provision that says any income not expressly listed is still taxable. This is incredibly comprehensive. With these changes, Nigeria joins countries like the UK, India, and South Africa in enforcing modern taxation for digital assets and complex financial products. Next up is employment income. The new rule is simple: everything related to employment is taxable. This includes your salary, wages, allowances, and bonuses. It also covers benefits in kind, which are non-cash perks like a company car or housing. Pensions and annuities are also taxable. The only things that are exempt are genuine reimbursements for expenses you incurred for the business. This means pay as you earn, or PAYE compliance is going to be much stricter under this new regime. Employers and employees need to pay close attention. The Act also addresses family income. For families that operate as a single economic unit under customary law, any income that belongs to the family as a whole is considered taxable. However, there is an important clarification: income from inherited property during the period of estate administration is not taxed. It only becomes taxable once it's distributed to the beneficiaries. This provides much-needed clarity for families managing estates. Now let's talk about trusts and estates. Trustees and estate executors are now explicitly brought into the tax net. This means if a trust generates income, that income must be taxed before any of the beneficiaries receive their share. This ensures that income generated through trusts doesn't escape taxation. And finally, let's revisit that residual clause I mentioned earlier. This is a very powerful anti-avoidance tool. The logic is simple: if an income stream is not specifically exempt and it has economic value, then it is taxable. It doesn't matter if it's not explicitly listed in the Act. This clause is designed to stop creative tax avoidance schemes and ensure fairness. To make all of this work, the NTA 2025 provides clear definitions for some complex financial terms. This is crucial for reducing ambiguity. For example, interest now includes yields from bonds and securities, foreign exchange gains on debts, charges on finance leases, returns from Islamic finance, and even hedging costs. The definition of dividend has also been expanded. It now includes bonus shares, debentures that are issued instead of dividends, and distributions during a company's liquidation. It also covers compensating payments made in securities lending arrangements. Royalty is defined as any payment for the use of patents, copyrights, software, mining rights, or technical know-how. The term money instruments is also clearly defined to include treasury bills, commercial papers, bonds, and certificates of deposit. Interestingly, the Act also clarifies securities lending. When securities are lent and then returned, it's not treated as a disposal for tax purposes. This is a smart move designed to encourage growth and activity in our capital markets. This level of detail and definitions is a huge step forward. It means fewer disputes and more predictable compliance for everyone. So, what are the broader policy implications of these changes? First, there's comprehensive coverage. The tax net now covers almost all sources of income, which significantly reduces loopholes. Second, it's about modernization. By including digital assets, derivatives, Islamic finance, and securities lending, Nigeria's tax system is now aligned with global financial innovation and tax technology. Third, it brings legal certainty. With detailed definitions, there's less room for argument. This makes the tax system more predictable for both taxpayers and the tax authorities. Finally, it's a strong anti-avoidance measure. Artificial arrangements, recharacterizing income, and other tax planning strategies that relied on ambiguity will now face serious limitations. It is also important to note that Nigerian case law has been moving in this direction for a while. For instance, the case of FBR versus Halliburton in 2016 established that tax must be expressly created by statute. In Vodacom versus FERS in 2019, the court confirmed that Nigeria can tax cross-border services that have a source in Nigeria. And a more recent case, FERS versus Checkpoint Software, emphasized that tax laws must be clear and that administrative overreach will be struck down. The new act essentially codifies what our courts have been saying for years, providing a solid legislative foundation. So, with all this information, what should taxpayers do now? Here are your first compliance steps. First, if you trade crypto, NFTs, or other tokens, you need to prepare for mandatory disclosure and reporting. Second, you must properly classify your financing arrangements, whether they are derivatives, leased assets, or Islamic finance products. Third, employers need to conduct a thorough pay review. Look at all allowances, perquisites, and staff benefits to ensure they are being taxed correctly. Fourth, trustees must register their trusts and prepare to file annual returns. And fifth, everyone needs to focus on documentation. Keep meticulous records of all your income. The new default assumption is that all income is taxable unless you can prove it's specifically exempted. These reforms also have global relevance, especially in the context of the African Continental Free Trade Area, or AFTA. Nigeria's new income definitions align with continental trends. The African Tax Administration Forum, or ATF, has been encouraging African countries to tax digital and cross-border transactions. Nigeria's reform supports this harmonization under the AFCFTA. Multinationals operating across Africa will need to re-evaluate their tax planning for their Nigerian and African operations. With these changes, Nigeria is positioning itself as one of the most modern tax jurisdictions in Africa. To wrap up, Section 4 of the Nigeria Tax Act 2025 has fundamentally changed how income is defined and taxed in Nigeria. The message from the government is crystal clear: if you earn it, if it has economic value, and it's not explicitly exempt, it is taxable. The era of ambiguity is over. Thank you for watching A Stitch in Tax Saves Cash. If you found this breakdown valuable, kindly subscribe to our channel and share this video. Our goal is to simplify tax for every Nigerian and every business operating in Nigeria. See you next time.